An income statement is one of the three key financial statements of a company, measuring the business's financial performance, showing the profit and loss from the income and costs over the period. It's also known as the profit and loss statement, or the statement of revenue and expense. Other financial statements also include the cash flow statement, showing how the business has made and disposed of cash and liquid funds during a period, and the balance sheet, a snapshot of a business's assets and liabilities on a particular day. If you want to know more about the balance sheet, please check out our balance sheet video after this. Today, we're going to focus on the income statement, what's in it and what it tells you. So now we know roughly what the income statement is, why do we care about it? As a shareholder of the business, we want to know what the business is actually making. Is it making a profit? When we look at a company valuation, we care a lot about the earning potential of a company so that we can pay a fair value for it today. Looking at how much income the company generates tells us a lot about its financial strength. So we've defined the income statement and we now know why it's important, but what really matters is understanding what's inside it. We're going to run through the income statement from top to bottom. Firstly, we look at revenues, the income earned from selling the product or providing the service. For Coke, think simply about the average price of a bottle of Coke and multiply that by the number of bottles sold. In real life, the company runs a much more complicated model with more products as part of its franchise. Now for the cost of goods sold. This is the direct costs attributable to the production of goods the company sells. This includes the materials used and the direct labor costs, but excludes things like distribution costs and executive salaries. For Coke, think about the factory workers, the plastic bottles, and the costs of the ingredients. The gross profit is the difference between the revenues and the cost of goods sold. It's effectively how much value added the company has put on top of the raw materials. When looking at the gross profit margin, we also like to look at the gross profit margin as a measure of the company's profitability. The gross profit made by the firm divided by the total revenue. All these figures can be found in the income statement. SG&A costs are the sum of all direct and indirect selling expenses and all general and administrative expenses of a company. These include sale commissions, advertising, promotional materials, and marketing, among others. The famous Coca-Cola Christmas ads are included in this category as they do not amount to direct sales costs. There's also space in this section for other operating charges that don't fit into this category. The operating profit section is calculated by taking the operating expenses away from the gross profit. It is useful as to show what the business's income is before thinking about financing and tax obligations. The operating margin measures the company's profitability in sales after paying the costs of production, but before looking at interest and taxes. It's calculated by dividing the operating income by the revenue. Interest expenses are the repayments of debt obligations taken out to finance business operations. It is an expense if it is a cost, but an income if the business receives a payment. If Coca-Cola issues bonds with coupons, the coupons will be included as interest expense as they repay their debt. After calculating the interest expenses used for repayment of debt obligations, we can calculate the operating profit before taxes. Taxes depend on the region the business operated in. If it is an international company like Coca-Cola, it will have a complex tax structure, as it has a headquarters, operations, productions, and sales in different parts around the world, and operate a franchise model. Finally, we come to net income, which is the net earnings of the company. It is the revenue minus all the costs incurred by the firm, and therefore is the earnings available to the shareholders. This is the most important measure of how profitable the company is. Now we've looked at each component of the income statement, let's put the theory into practice. Imagine you're a shareholder of Coca-Cola, and you want to know how it's doing. You want to understand the financial performance of the company. So you look at the income statement. Let's break it down, knowing now what you know. For this screen, you may wish to pause at times to read the figures. In 2018, Coke had over $31 billion in revenue. As the shareholder, you want to know how much of that is available to you, how this has changed year by year, and how the costs have been broken down. Firstly, we can see that year on year, revenues have fallen. On the other hand, Net income available to equity holders has increased from $1.2 billion to well over $6 billion. So why is net income up even though total sales have fallen by 10%? Well, firstly, as revenues have fallen by 10%, cost of goods sold have also fallen by a similar amount. Remember that the cost of goods sold is the direct cost of selling the products, and therefore this makes sense. This means that our gross profit margin is pretty much the same. Where we start to see large cost savings is in the SG&A expenses, which have fallen by 19%, and other operating charges, which have fallen by 43%. We can see this downward trend over the prior 3 years in SG&A costs, which is great for the firm. We can see this in the operating margin increasing from 21.5% to 27.3%. Where we look at the interest and taxes of Coke, we can see that interest expenses and taxes have risen year on year, which means that there are larger detractions from our income figure. We can see on the bottom line that the net income is a lot healthier in 2017, which seems like an anomaly year. So the key takeaways of this will be that sales have fallen on the top line, but that net income to us as shareholders has increased a lot over the past year due to operating costs falling, and the net income figure is comparable to that in 2016. What do you think about this income statement? Let us know in the comments.